We've been talking a lot about how breadth has been expanding in the marketplace. And the bears, they keep talking about narrow breadth as if this is some harbinger of doom for stocks. We did a great study in this one. I hope you like it. Narrow leadership means more pain for the bears. That is right. When leadership or breadth is weak, it's actually very bullish for stocks going forward. So let's go ahead and set the stage. So if we look at the data right now, in 2023, only 28% of S&P 500 stocks are outperforming the index. You can see that with this bar here. It is the lowest that we've seen since 2007. So you're talking about 15 years. We're seeing some weak breath and the bears are beating the drum. But let's keep moving forward. Narrow leadership, it's actually bullish, not bearish. So here we are, we're looking at quartiles going back to, look at this, 1928. So almost 100 years of history. And we've got breadth in 4 different quartiles. So the highest breadth, that means a lot of stocks are moving higher, they are outperforming. The forward performance 1 year later is only 7.4% for the S&P 500. Whereas if you look at the lowest quartile of breadth, which is what we are in right now, the forward returns for the S&P 500 are 15.4%. So keep in mind, the average return every year going back many decades for the S&P 500 is right around 10%. So you may ask, well, why is weak breadth more bullish? Well, maybe that means that a lot of stocks are undervalued, right? And so value hunters, they're going to be going out and scooping up stocks on deals. Whereas when everything has rallied so much and your mother is long stocks, your brother is long stocks, well, maybe there is less for stocks to move higher. It's already priced in. Wow. RIP to the bears. Let's keep going. So how do we look at this in our data? Well, the first thing is we put a score to every single stock. We even score sectors overall. And we're beginning to see over the past few months better sector participation. So scores, they continue to go up. So while the bears, they're growling and they're saying, oh my goodness, there's so much weakness under the surface, it's just not true. Map Signals has been showing you that the money has been flowing into stocks literally all year, but the bears, they don't want to hear it. Also, how do we know? What is a great way to visualize that breadth has been getting stronger is literally probably the best indicator out there, in my opinion. That is the Big Money Index. It measures the rate of institutional buying and selling. This is totally unique. Look at this yellow line. It has been going up literally all year. That is telling you that fund managers are getting longer stocks no matter what you are hearing in the media. This is real, actual data. It tells you the actual story of what's happening. But you got to say, what is happening with market breadth recently? It's actually starting to outperform. So this is a great chart. This is looking at year to date over here on the left side. You've got the S&P 500 equal weight. Okay, so that is an equal weighting of all of the S&P 500. They're up 5.9% versus the market cap weighted of the S&P 500. It's up 16.4. No doubt the big behemoths, they have been contributing to a lot of the S&P 500 gains. But if we look at a 1 month basis, we can see that the equal weight has marginally outstripped the S&P 500. So that is telling you breadth continues to improve. And we all know, based on history, that means that there should be forward gains that are exciting for the market. So how can you play this? Well, you can look at an equal weight ETF, RSP. It's an equal weight of the S&P 500. Chances are we think that breadth is going to continue to expand, and history says this is the time and the place to be making bullish bets rather than bearish bets. Okay, I am out of air. You guys have a good one. Remember, this is not personalized advice. You guys do your own research. We will see you next time.